Well, if you're wondering why farmers are so concerned about their farm finances right now, they really just can't catch a break. It's not just because corn prices are below break even for most. It's the fact input prices are so high.
The U.S. has lost the corn crown. We've been the world's top exporter of corn for just about every single year in history.
China has abruptly stopped orders for U.S. soybeans and corn as tariffs intensify, dealing a severe blow to American agriculture. The USDA has axed local food purchasing programs that supported Humboldt schools, tribes, seniors, and food banks while bolstering ranchers and farmers. Corn prices have crashed to $3.50 per bushel, plunging the U.S. Corn Belt into chaos. Importers sent back over 2 million tons of corn to New Orleans, rendering million-dollar contracts worthless overnight. In Iowa and Indiana, combined stand still as harvesting now deepens financial losses. Kernels rot under rain-soaked fields, resembling a massive grain graveyard. U.S. farmers face mounting loans and eroded trust, while Canada secures multi-billion-dollar supply deals with Japan, South Korea, and Europe, quietly dominating global markets. Why has U.S. corn collapsed so rapidly since early 2025? As Canada seals lucrative agreements, this video uncovers the fractures in America's grain industry and explains how Canada claimed the global grain crown. Tariffs are strangling U.S. corn exports right at the docks. After the White House slapped fees of up to $1.5 million per trip on China-built cargo ships, Gulf of Mexico shipping costs surged by 25%, adding $930 million annually to export expenses. Trans-Pacific container rates have been relentless, with Asia freight doubling to $5,000 per FEU in the first 2 months of 2025. A second blow came from pesticide residue testing fees. On March 14, 2025, the Federal Grain Inspection Service raised the multi-residue export test fee from $57 to $81 per sample, a 40% hike in one crop cycle. Every U.S. corn shipment now requires this costly certification or faces rejection mid-ocean, inflating expenses while shipments stall. The February 6, 2025, Grain Transportation Report revealed a 16% drop in Mississippi River barge traffic compared to the 5-year average. New Orleans ports are gridlocked due to shortages of empty containers and new security documentation. Over 180 vessels linger at anchor, leaving Iowa and Indiana corn to spoil. Farmers lose 27 cents per bushel just waiting for a ship. Meanwhile, global import standards now demand clean, green, and blockchain trace grain. In February 2025, Mexico banned GMO corn, prioritizing low-carbon certified grain, a trend echoed by Asian and European feed mills. With 92% of U.S. corn being GMO, America was dropped from preferred supplier lists. Canada, leveraging its Prairie Trace blockchain to track every lot, secured billion-dollar contracts with Japan, South Korea, and the EU. The fallout was immediate. Midwest spot corn prices fell to $3.45 per bushel, the lowest since 2016, while Manitoba's Canadian corn held at $4.20, boosted by a carbon-free premium. Global traders pivoted to Canada, citing higher U.S. costs, lengthy testing, and GMO restrictions. Canada's green label now commands a 20% price premium at top ports. The global corn trade is shifting at New Orleans docks, where rejected U.S. contracts pile up as Canada's flag flies high. With rising logistics and inspection costs, the question isn't when U.S. corn will recover, but whether it still has a place in global markets. Picture Shelby County, Iowa, awash in unsold corn no one wants. Reuters reports that U.S. farmers' unsold corn stocks have hit a 6-year high. The USDA projects that by September's end, over 2.5 billion bushels, 68 million tons, will remain stuck in silos, exposed to sun and rain. In Cedar Rapids, the cash bid for September delivery is just $3.74 per bushel, while Iowa's 2025 harvest costs average $165.75 per acre. This gap explains why farmers are selling combines on Craigslist or driving Uber to survive. Some Indiana households hold back 90% of their crop, as selling now only deepens debt. In Indiana, the economic toll is stark. The state's Economic Council reports a 6.1% contraction in Q1 2025, the second worst nationwide. Rural counties face a surge in food aid applications, with Indiana's food bank noting a 50% rise in households seeking help. A proposed budget cut threatens to eliminate 133 million meals for the poor. In Illinois, the Mississippi waterway, at record lows for 3 years, forces shippers to lighten loads and shorten routes, adding $20 per ton to Gulfport costs and delaying sailings by up to 15 days. Crops pile up, and farmers face rising interest rates as land funds buy up acreage at bargain prices. The Midwest Farmland Deal Index rose 6.5% in April despite a cooling market. Some rural Illinois schools have shifted to 3-day online schedules to cut costs, per the CTE Rural Illinois report. In Nebraska and Minnesota, dubbed the Underground Corn Vault, irrigation cuts under new Little Blue NRD rules limit water to 13 inches per acre annually, forcing co-ops to pause purchases to avoid overflowing bins. Along Highway 6, grain trucks vanish, gas stations struggle, and a Hastings diner closes its grill by 6 p.m. for lack of customers. Local papers call it a zombie economy. Stores open, but cash flow dead. Ethanol production, a key corn market, is faltering. An EIA report shows Midwest ethanol run rates at 87.8%, with 25 plants closed, idling 1.26 billion gallons of capacity. In Columbus, Nebraska, Valero's plant cut 60% of night shifts, laying off 120 workers, further shrinking corn demand. From Iowa's overflowing silos to Illinois' clogged waterways and Nebraska's idle pumps, each link in the chain fuels the crisis. U.S. corn, once a Midwest cornerstone, is not only losing value, but suffocating rural communities. While Canada secures billion-dollar deals, Washington faces a grim question: not when corn will rebound, but how many towns will become ghost towns first. Canada isn't rescuing U.S. corn. It's carving out a premium market with methodical precision, offering importers the reliability of a Swiss watch. Every Canadian export container includes blockchain tracking from seed to terminal, minimizing counterfeits. A Farmit report notes that North American exporters now rely on blockchain for traceability, with Canada's Ontario and Saskatchewan co-ops leading the charge. Traceability alone isn't enough. Ottawa enforces a 3-no's policy: no GMO, no glyphosate, and no carbon emissions above the EU's RED II threshold. Canada's unified disclosure platform for corn, compliant with the 2021 RED II guide, clears EU customs 20 days faster than U.S. grain. June 2025 market trend from grain farmers of Ontario show old crop basis at $1.30 to $1.87 above CBOT futures, a 22 to 30% premium. New crop corn fetches $1.49 more per bushel, 18% above Chicago prices, explaining why Asian feed mills pay extra for Canada's green reputation. In March 2025, Canada and South Korea signed the CSKEA Organic Equivalency Deal, enabling Ontario co-ops to secure a 5-year supply contract with a major feed mill group within weeks. Saskatchewan capitalized on a weak Canadian dollar and US-CU tariff disputes to sell non-GMO corn to Japan and the Netherlands. USDA Ottawa reports Canadian exporters diversifying due to Washington's 25% spot duty, with EU fall 2025 contracts averaging 18% above seaboard, a level U.S. farmers can't match. Ottawa's safety net is robust. Export Development Canada offers single-lot export credit insurance and reimburses up to 50% of cold chain logistics costs to maintain low-carbon certification. These incentives, promoted on EDC's portal, empower farmers to meet strict standards and avoid rejections over residue tests. Meanwhile, U.S. grain shipping falters. The USDA reported only 30 grain ships loading in the Gulf the week Canada signed CSKA, down 14% year over year, with 10-day bookings off 17%. Reuters notes importers are shifting to Vancouver, where Canada's rail grid leverages cheaper backhaul rates from Asia. North America's grain trade now tilts toward Canada. From blockchain to double-digit premiums, Canada plays a new game. While Iowa farmers cut losses, Toronto counts new orders as seaboard stays red. U.S. corn, once a global staple, now risks collapse. If the crisis spreads to soy, 92% GMO, and already off Europe's low-carbon list, dairy and beef will follow. Feed costs will rise, threatening small farms with bankruptcies unseen since the 1980s. Canadian and Australian meat, backed by net zero pledges, will outpace U.S. beef under heavier carbon taxes. Washington faces two paths: reverse protectionism, cut tariffs on green tech, adopt blockchain traceability, and align with global carbon rules, or maintain tariffs, complex inspections, and subsidies, a path that doomed the Rust Belt decades ago. The first demands political courage, but restores U.S. farm credibility. The second hands Canada the sustainable brand and billions in global sales. Time is running out. Will Washington reroute the rural economy, or let it derail further? Comment below, as the next move impacts not just corn prices, but millions of American livelihoods.